Right, could we invite the first affirmative speaker to begin the debate?
Am I audible? Awesome. I will start my speech shortly. Panel, I think it's incredibly important to remember that this debate is about the advent of a new technology. It is really important to think that this debate is probably going to reward a team who can give you accurate and compelling reasons that you should think the advent is going to work in a certain way, considering what technologies look like at the moment, but also believing that progress can happen. A couple of pieces of setup. Firstly, what is a decentralized financial system, which I'm going to call DeFi? So DeFi refers to a financial system that is based in the blockchain. I think this gives rise to two subsequent questions. Firstly, what is a financial system? And secondly, what is the blockchain? A financial system is a set of institutions and practices that facilitates the financing and exchange of assets and goods and services. We think this looks primarily like things like stock exchanges, banks, the transfer of funds for asset acquisition, but also like large-scale transfers of wealth and things like that. The second thing is, what is a blockchain? A blockchain is technology where ledgers of data are kept on a decentralized network of computers, which updates simultaneously because of their connection to the internet. This means that when one change happens, like everyone's computers around the world reflects this. This is how, for example, like Bitcoin is mined or all the other cryptocurrencies operate. The second thing is, what is the advent of DeFi or of this kind of financial system? Three things here. Firstly, do not let the negative run away with this and say that we are supporting blockchain explicitly or something like that. Firstly, we think that cryptocurrency is but one example of something that could operate in a financial system, but it does not represent the sum total of this. We would point, for example, to the fact that you can have smart contracts in financial systems, which keep permanent records of financial transactions in ways that aren't literally just like Dogecoin or Bitcoin. The second thing is that we think the more likely alternative of this to it just being a debate about Dogecoin is that it's things like Ecuador underwriting their entire country's financial system and currency with the blockchain, which they did about a year ago, which has worked perfectly fine thus far. We would say because of this size, we think, and remember that we're at the advent, we think that it is much less prone to fluctuation than these individual cryptocurrencies, because currently they are being treated as kind of assets in a manner similar to the Dutch tulip bloom, whereas we think that these will turn into being considered much more like tools rather than something that you put your money in as a bit of a gamble. But the second reason is because they can be adopted by institutions, which is why they're less prone to fluctuation. Again, we point to Ecuador. Second thing to think about is the advent means we are at the beginning. What do we think happens here? Firstly, we think that this technology and this financial system is likely going to be able to be rolled out by developing states like Ecuador, like other countries, particularly in the global south. The second thing is that we would note that the internet is really hard to monitor. We point to things like the VPN, which have stopped the CCP being able to crack down on Facebook use in China. And so we think that it is very hard for, at the advent or at any point continuing, for any state to ban the use of this kind of technology. We think, for example, they are likely to instead engage in regulation because they would like some level of control over the system, but they cannot strictly forbid the use of a decentralized system. The last thing to note is that we are not proposing the abolition of traditional financial institutions like banks. We think that there are lots of reasons that they may continue. For example, people like having a relatively safe and secure place of earning interest and putting their money just to kind of set and forget. But the other thing is that we would note that all we are offering is that this proposes an alternative for people and for countries for whom the system is not currently working. 3 points tonight. The first being that this is better for the developing world. We note that there's a couple of reasons that you should weigh in this material particularly strongly, because we care most about the developing world because principally they have been the most disadvantaged and deserve the best reparation. But secondly, because considering the scale of sheer human happiness, there are more people in the developing world than the developed one. There are two characteristics about financial systems in the developing world that tend to be true. Firstly, they are often unstable. This is for a variety of reasons, perhaps because they have a capricious dictator at the head of their state, perhaps because their economy is highly unbalanced and only focused on one specific extractive resource or something like that, or perhaps because they are plagued by violence or instability, which unfortunately mars lots of these countries. Things like civil wars where the banks are overrun, things like the productive capacity being seized or firebombed, which happens in Eastern Congo. The second thing to note about these systems is that when they are not unstable, it is almost always because they are being actively propped up by the West. This looks like two different examples, which I'm going to give you. Firstly, we point to the Central African franc, which is used by 12 African countries at the moment. This is, like, on the surface, seems like a perfectly fine thing. France prints the Central African franc, which is then used by these countries. But we would note that this is possibly one of the most absolutely egregious and devastating ways of expropriating wealth from this country, expropriating wealth because France, by underwriting this currency, is able to literally force Sierra Leone to hand over nearly 50% of its GDPs into the French state coffers as a kind of payment for the use of this currency underwritten by France, because they promise stability, but they actually give you exploitation. The second thing we would note is that the World Bank and the IMF have a strong history of giving loans to help you develop your country, which are incredibly damaging and pernicious. These loans are often in US dollars. They are conditional on you taking away all labor protections and environmental standards that may exist in your country, but there is no alternative at the moment for developing countries because no other currencies are strong enough. You have to trade in dollars, you have to trade in euros. This is absolutely awful for their outcomes. What does this mean for DeFi? We think that it is a viable financial system that can be explored by developing countries. We point to empirical evidence that this is true. We think that they are likely not to totally break from the past or break from tradition. Note again that this is exploratory. This debate is happening at the advent. It is going to develop further, but also that they're likely to do things that are kind of more moderate in the short term, things like underwriting their currency with blockchain. We think that they're still likely to stay engaged with the current financial system for a couple of reasons, because it's easier for governments to regulate, which is naturally in their interest, but also, again, I point you to the examples that I gave you about why people might want to use traditional banks as well, because of their offer of stability or of interest rates. The impacts of this are, firstly, this is a system that is very easy to expand because all you really need is an internet connection and a bit of will. We would note that you can do things like roll this out in a variety of developing countries, giving them avenues for mutual aid that have never existed before, that are independent of like capricious fluctuations in the US dollar. We think this is an incredibly significant benefit because it happens for so many people and so deeply affects their way of life. The second thing is we point to empirical scholarship done by like radical progressive scholars who say this is probably one of the best ways and only avenues out of poverty for the developing world. We note that the negative team's burden here is to prove that this could go so disastrously wrong that these benefits cannot accrue. We think we have given you persuasive reasons that they're likely to. The second reason this technology is good is because it offers an alternative for individuals who don't want to engage with the current financial system. We think this is a principled good because it means that people are able to opt into things that their government is doing and opt out when their government is doing actively really, really bad and damaging things with the financial system, whether this is US imperialism and exploitation or worse, Russian corruption and like the formation of oligopolies and financing of an immoral war in Ukraine. But secondly, because we think that governments often behave very badly and spontaneously in financial systems. Again, we point you to like the way that Russia treats oligopolies, where it actively tries to manufacture anti-competitive systems, but also to things like the GFC, where government choices about bailing out really large financial institutions, but also the regulations that they set on them, which were highly undemocratic, caused massive financial devastation for people all around the world, none of whom had democratically opted into it. The last reason that we think this is a really good technology is that it is a massive preventative agent against corruption. Firstly, it is incredibly visible. It is impossible to erase things from the ledger, so people are able to see what governments, but also individual actors are up to. The second thing is that when your state is using technology like this, we point again to Ecuador, you can see the state coffers very visibly. Governments cannot be evasive. They cannot hide what they are doing if they are being corrupt. You cannot steal from the coffers when everyone can see the balance sheet changing. But the last thing is that we cut out corrupt middlemen, people who are likely to like propound in the developing world, who can abuse the current system, but will not be able to in the future. The impact of this is obviously incredibly important. Corruption is terrible. It is a huge drain on developing countries. So proud to propose.
Good question.
One sec.
Right, thanks. Can we have the first next?
I'm just checking that I'm audible. Great, thank you. I think the problem with that side affirmative case is at the end of that speech, it is just deeply, deeply unclear as to why that the world that they propose is going to be likely to look like how new decentralized currencies are going to operate, why the greatest adoption of decentralized financial systems was ever going to be by nations, and why it was ever going to deviate from the trend that we saw overwhelmingly throughout the construction of these decentralized financial systems, which was overwhelmingly one of poor regulation, one of exploitation of its consumers, one of extremely high positive externalities across a variety of areas, including the environment, including crime, including globally. For all these reasons, we thought that the advent of new decentralized financial systems was always something we would not support. It was always something that ought to be regretted. Two things here. First, on the ways that individuals interact with these systems and why they are so harmful, and secondly, on the variety of externalities that negative externalities they bring. First thing in here to note on how individuals engage with these systems is just how deeply, deeply poorly regulated not only they are currently, but how they are likely to remain in future. And a series of reasons here. First thing to note about these decentralized financial systems is just the fact that they are incredibly new, means that they require do not operate under existing illegal protections, do not operate under any existing guidelines. Secondly, then, just that we see massive amounts of time lags that are likely to persist in responding in the necessarily regulations here. The reasons such as the massive structural delays that just exist in the ability of governments to implement new legislation just due to the necessary time lags, due to things that like the filibuster, which just nuke the ability of governments to pass legislation effectively. But just thirdly, just because they lack the sufficient amount of information and technical expertise often to be able to regulate these decentralized markets effectively, which is a problem that only gets worse as you continue to add new systems into the system. This was always something that was going to be bad. Why was this then so harmful? It meant that for one, you just did not have things like a basic degrees of consumer protection and basic guarantees, right? You didn't have sufficient levels of guarantees and protection against things like insider trading, against things like guarantees on actually being delivered the products you were paying for. You didn't have the ability to sue these people when they conned you out of your money. You didn't have the ability to access sufficient information. You didn't have the ability to sue people for giving you the incorrect or misleading financial advice just because you did not have the same degrees of structures to hold these people to account, which always meant these people were way, way less protected compared to traditional financial markets, compared to policies which prevented things like insider trading, compared to markets which were comparatively substantially more stable. Secondly, then these markets were just always necessarily way, way more volatile compared to traditional financial markets in a way that was going to be incredibly harmful. First thing here is just that to note is that these decentralized markets necessarily aren't attached to underlying assets in a way that can actually guarantee their value, right? Because compared to other types of financial assets, for example, things like equity in firms, which is actually staked to material value held by a company, or even compared to something like fiat currency, which is backed by the country itself, which is sufficiently large that it's able to insulate itself against things like shocks, that's able to be managed well and isn't going to massively fluctuate, or even things like commodities, which still have a real underlying value. These decentralized systems have nothing to back it, which meant necessarily the only thing they ever had going for them was confidence. And at the point where confidence was disrupted, at the point where confidence fell, all the value of that currency fell with it. You left people incredibly vulnerable to things like massive shocks, and that is particularly important because everything they tell you about the adoption of these currencies by developing nations, by these vulnerable actors, would be something that would be horrific because you leave them entirely vulnerable to these massive fluctuations in value. These were the people that were the most likely to be incredibly harmed. These assets don't hold intrinsic value and therefore never could ever be protected. But secondly, then, just apart from their innate fluctuations, there was just also often massive incentives to distort the value of these novel systems, right? Because of the types of actors that were actually assisting in their creation and dissemination to begin with. It looks like things like massive crypto influencers propping up specific coins, trying to get mass investment, being able to sell at a peak price, being able to leave everyone in the dust. It looks like being able to have that really direct connection with the base you were marketing to in a way that you could never have under a traditional financial system where you actually prevented insider trading, where you actually were able to denounce and outlaw this conduct effectively. For all these reasons, you got things like horrific bank runs, you got horrific loss of confidence, and so even under both worlds, it's like people were likely to make poor financial decisions. We thought it was always better that people be making the financial decisions under a financial system which actually was able to protect them, which was able to give them adequate amounts of information, which guaranteed them against things like massive volatility, which majorly guarantee their assets there, right? Because when these coins, when these systems inevitably lose their value, it looks like people losing their life's asset. It looks like people no longer being able to withdraw due to liquidity crunches on these exchanges. It looks like people effectively gambling away like the life savings. This was always something that was going to be regretful. So, secondly, then on externalities, and three parts to this argument. Firstly on crime, secondly on the environment, and thirdly on just your opportunity cost. So firstly then on crime, and I'm which is to say the is that like fundamentally decentralized financial systems just facilitate crime. They facilitate corruption to an even higher extent necessarily, right? Because these systems were invented with the very idea for one, like many were invented for money laundering purposes explicitly, but secondly because you don't have the same levels of requirements on them as traditional systems such as banks, right? Banks necessarily have to verify the identity of people they are transferring money between, otherwise they are complicit in money laundering. These same regulations don't apply to things like currency exchanges, and therefore you just massively facilitate the ability of people to engage in things like financing crime or even engaging in things like financing corruption as well. Then even if we didn't prevent the incidence of these actions to begin with, we just simply made these things easier to catch at the point where they went through traditional systems. We made them, we forced these criminals and corruption to devote more resources to pursuing these things. All of this is stimulate their ability. Secondly, then on the environment, right? These technologies just do overwhelmingly require massive amounts of computing and power. They require things like individually verifying every individual link in the blockchain. They require things like massive amounts of electricity devoted towards cryptocurrency mines, sometimes equal to like the entire energy consumption of a small country. This was just always the extent to which we increased the reliance, energy reliance was always going to be incredibly harmful, something we would regret. Thirdly, then on the final opportunity cost, which is just to say that all of the technologies that we could devote to developing these new things, all of the resources here, all these graphics cards, was something that we prefer be allocated towards better, more normal methods. At the end of this, is so clear these systems were horrific for the individuals involved. They came at a massive cost. So proud to.
All right, thank you very much, first negative speaker. Can we invite the second affirmative speaker to advance the affirmative case here?
Panelist team suffers from a lack of comparativeness because it was true that in the status quo, developing countries' economies often collapsed, their financial systems were prone to instability and corruption. It was true in the status quo that most financial systems were backed by mere confidence and not actually imaginary reserves of gold or minerals that could prop up the entirety of, for example, the Australian dollar in circulation. And it was true in both worlds that the types of regulatory systems that operated on top of the financial system were not themselves unstepped out imaginary financial checks and balances, but were instead things like the Australian Securities Commission, were instead things like the judiciary system, were instead things like that can still exist and would in fact be bolstered by the transparency that decentralization brings, things that governments had every incentive to continue using and every incentive to adapt to this technology at the point at which they had to. Okay, 3 issues. Firstly, on the rollout of this and how individuals will interact with it. Secondly, on externalities and pushing our margin. Thirdly, on market volatility and some other benefits from us. Firstly, on individuals interacting and the rollout. This is where most of their pushes were. The first push that they give you is there is going to be poor regulation because these systems are new, because there is a time lag between when these systems exist and the point at which you would have the regulatory capacity or incentives to properly be able to engage with the systems. But this misunderstands both A, reality, and B, what Olivia steps you out at first, which it is not that individuals are opting into Bitcoin and then Bitcoin becomes so powerful that as a country you have to play catch up. It is rather that the advent of blockchain has precipitated and provided an avenue for alternative financial systems and alternative decentralized financial technologies, which can be rolled out by groups, which can be opted in together, which can be used to underwrite currencies and thus provide smooth transitions between centralized and decentralized financial systems for the benefits that that brings, such as that has happened in Ecuador. There wasn't a regulatory gap because you could glide them together. There wasn't a regulatory gap because you weren't being forced to do this. It was something that people were opting into and were only ever became sufficiently large in either side of the house when you had some sort of powerful actor or mover going behind it. Otherwise, things just looked like Bitcoin, and that wasn't what this debate was about. The next reason that they give you, besides that mischaracterization, is expertise. I thought that once again, this was uncomparative. In the developing countries, you didn't have the expertise often to control financial systems in general. And that as well, it falls to Olivia's analysis about why it is easier for countries to opt into each other's financial systems, citizens like having currency reserves in other countries, or alternatively, countries banding together. Note that in East Africa, they've been trying to get the East African shilling off the ground for around about like 20 years. It's really difficult to do when you are materially trying to combine things like banks, infrastructure, the on-the-ground stuff that is really hard to like reach some sort of accord to. When you roll out decentralized technologies, it is easier to come together as governments and do things like cross-border investment, which promotes stability, which provides avenues for not being at the capricious whims of your government, avenues against the types of destabilizing events that Olivia wanted to talk about. The final thing that I'm going to talk about on this rollout is, and I alluded to this in my introduction, that they misunderstand how regulation occurs when they want to say that regulation occurs like in general in some vague financial way, insider trading. Was it something about the way that I gave you money and you gave me money that stopped in like insider trading happening? Or was it like, I don't know, the law and the coercive power of the government, things that you now can enforce and investigate better when you can see insider trading happening because the ledger is public, because everyone has access to the ledger? It also doesn't engage with the imaginative stretch of information which Olivia gives you, such as how things like contracts are likely now to be verifiable, cross-border, cross-party, how those things make it a lot harder to wiggle out of things, a lot harder to coerce and manipulate smaller and weaker parties in financial dealings. At this point, we're ahead in why it would be rolled out in beneficial ways, ahead in explaining why it has been in Ecuador, and ahead in pushing the burden onto them to show why the advent of the potential for these systems precipitated by blockchain would be done badly when it is not being done badly anywhere in the world right now, how that could possibly stretch into the types of harms that they wanted to accrue, something that maybe this debate could have been about, but they've failed to push at. The next thing on externalities, firstly, on the environment, I can understand why they would think that this was an intuitive push, because you hear in the news, Bitcoin costs a lot of environmental money to run miners and that type of thing. The thing is, when people are running news articles like that, they're talking about the cost of Bitcoin to the environment in general. They are not comparing Bitcoin to the cost of normal financial systems, to the cost of printing money, to the cost of having banks and all of this physical infrastructure and all of the energy consumption that goes into the mint and all of those other types of things. If they were, that would be a very different discussion because there is a level of symmetry there. But note as well that blockchain was here and was going to stay here regardless of whether or not DeFi, like the advent of DeFi was also here, which it is, which meant that a lot of the harms that they had about people opting into things like Bitcoin actually lessened on our side when you gave people less of a reason to engage in speculative crypto dealings, because there was like another type of DeFi or digital currency which models the way that it was always meant to work, models the way that Bitcoin was working before it became a speculative investment thing. The next thing that they say is corruption, because banks verify your identity. Like the reason the Solok topic was set is because your identity is verified by the blockchain. Everyone can see it and where it is going. That doesn't engage with government's incentives to regulate. But note as well that I thought you could have blockchain identifiers. In Pakistan, the Nadra system of self-identification gives individuals a 13-key identifier that is used for things like financial systems. That is not what DeFi is, because obviously that is quite centralized. But in the same way you can have those identifiers, that is what like a blockchain wallet is likely to look like. That is what it's likely to look like in Ecuador. Those responses also apply to crime, but I'm going to flip that further when I tell you that if anything, you incentivize regulatory capture of crime if you actually make it more difficult to regulate and control criminals. You incentivize things like legalizing the trade of drugs and that type of thing to try and capture it regulatorily, which has been really successful in Portugal and the Netherlands. I think that things like sex work and drugs, and where most of the illicit money are, the world would be better if we didn't have the war on those types of things. That was the big burden that they needed to prove, something that they wouldn't intuitively being able to. But I think as well, flipping this further, and this is a discrete new thing, I think you make firms more willing to engage in the developing world for investment, because currently they have a barrier in that they don't want to deal in your poor, unstable currency that they don't know what's happening, and they have to factor in the risk of that. If you make it somewhat less risky, somewhat provide them with like an alternative underwritten currency system that doubles the amount of stability, that provides other mechanisms, they were more likely to invest. Okay, at this point we're ahead. What else am I going to tell you? When they tell you that pump and dump works, that seems like some vestigial argument that they were unable to fully let go of in the context of the debate that Livs brings to the table. But we tell you that these currencies are likely going to be more resilient because you have the underwriting of them in country, but also facilitate cross-country interaction. This is the type of thing that allows you to say, if cross-country interaction, which also has positive externalities, say you can do things like popular insurrection more easily if your government is coercing and controlling you, because you can invest in and have money in, say, your neighboring African states because of that decentralization. You can exert pressure on your governments in that way. You more easily facilitate systems like cross-African currencies. You more easily facilitate things like transparency, all of those things, the decentralization of it from just a larger ambit of things that harm could be done to, were ultimately going to make it more stable. Note that this debate was never going to be about imagining an entirely different world. It was about a technology which was here, which was being used discretionarily, and that required a fine-tooth comb and adjudication. Incredibly proud to propose.
Thank you. Can we have the second negative?
Hey, sorry, just gonna give me a bit. I got a lot of paper on my desk. Cool. Just checking out if we heard. First thing I'm going to do in this speech is try and give some clarity as to what the advent and consequential use of decentralized financial services look like, because I think they throw around a bunch of words like underwriting, and that like countries are going to share a cryptocurrency, and so there'll be lots of them, but also there'll only be one, so it'll be centralized and it'll be stable panel. You must just simply look at the way in which decentralized financial systems have been used in the status quo as a good indicator of the way that they will probably be used in the future. Because it's true that this debate is speculative and is forward-looking, but insofar as the advent of decentralized financial systems has already occurred, we can use that as a good demarcation. And that means that all the harms that we brought you about how there are really perverse incentives to implement this, but also meant that things like Venezuela's failure to actually implement these currencies in a way that people were going to use it was all really important, because they never explained you any concrete benefits of developing countries being able to use this. Never explained why the integration would actually happen well, which is why they end up with almost no benefits. A few things about clarifying what we have to defend. One, if governments are going to use blockchain, for example, underwriting contracts with their existing currency, that we are able to defend that under our side because it's not decentralized. Obviously, this obviously occurs for the general use of blockchain to underwrite centralized financial systems. We can defend that fine. Firstly, then on developing nations and investment across borders. Why do they say this is going to be good for developing nations? Note, they set up with not a benefit, but with complaining about the current system. Firstly, they say that current financial systems are unstable. We explained why this is symmetricized by the general instability associated with these blockchain currencies that I'll get to later. But moreover, the reason it's unstable in the status quo is because you don't have access to things like institutions. Obviously, if your country is, for instance, in a civil war, you lose access to things like the internet. You have things like that decentralized currency pull out from your nation in order to protect its value, which is exactly why it was going to be just as volatile and just as bad. Secondly, they say that you already outsource your currency and this enables you not to do it. But obviously the incentive for countries to outsource their currency was because it would, for instance, be underwritten by a larger nation like France. If they didn't explain why they couldn't just establish their own currency. And insofar as that was true, they don't explain why they can actually establish a decentralized currency under their side. Thirdly, they say that things like IMF loans are pernicious. But the problem is they never mechanized why you actually get capital investment into your currency. Because obviously you can do things in the status quo, like underwrite with the US dollar or hedge against other currencies. Note, in developing countries, many of the countries already are hedged against the US dollar. That simply means the only way that they're able to get more capital is if your investment is more risky. And then when your investment is more risky, you have to do things like pay higher interest on that investment, which is why they never sought out investments from corporations at the moment. Alternatively, you're just more likely to turn to other like risky investments in these Bitcoins. The next thing they say is that, well, you're able to integrate your economy and you underwrite, although weirdly concessionary that they say this probably won't be full. I just want to intuition check the example about Venezuela they keep using. This plan was a failure, right? The plan was to integrate the economy with blockchain. The problem is no one wants to install card readers, which allowed you to buy things like food and water with blockchain, which is exactly why the integration was a failure. And they just spent a bunch of money developing infrastructure that was literally never used, because we would tell you that there is an adoption problem, right? Even if this decentralization is good in theory, countries can never use it because people do not have access to the technology, because developing the infrastructure to actually enter day-to-day transactions with these currencies is extremely difficult and extremely expensive. But moreover, the problem they identify with an access to things like a safe saving avenues is fixed in the world where their benefits accrue, right? Because to access the blockchain, you have to have internet. And that is why companies in, for instance, rural India are developing mobile centralized banking using existing currencies and using existing technologies. As soon as you get internet, you are able to access the traditional system and get things like reliable returns on your savings and get things like the accrual of savings so that you can buy things and invest in assets and whatever. But it occurs as soon as you get internet access, which is also when all of the benefits occur, which is why they literally get no benefits out of this. Finally, they say, well, you're now able to share with other countries more. Firstly, they say that you can develop a shared currency, but obviously it is just as hard because, for instance, you have to agree on things like, well, is this currency going to be hedged against other things? But also countries are just as reticent to integrate their currencies in the status quo because you risk things like losing the extent to which your currency is a macroeconomic shock absorber. Secondly, though, they say that you can invest overseas, particularly in the developing world, but obviously you still have to interface with your economy, right? So even if you're investing using a decentralized financial systems, they're just as reticent as soon as they interface with your economy because you still have the same risk of these things fluctuating. But beyond that, as I flagged earlier, you can just already use the US dollar for the same purpose, and they don't describe why it's inadequate. Panel, at the end of this, you should probably believe that there is just really no benefit to actually using these decentralized financial systems in these economies. Their best case is that maybe you get a tiny bit of investment from overseas. Importantly, we explain why that investment is just going to be more expensive anyway and not that beneficial. With that out of the way, why is the very structure of these currencies necessarily damaging? We tell you that these structures, that people are going to engage with them quite poorly, not only because they're poorly regulated, but also because people aren't very financially literate. On the whole, people make bad financial decisions. But in the status quo, you have things like the assurance against bank runs if people make bad financial decisions. You have things like the underlying assets of equities. So if people make financial decisions, they can't lose all of their money, they can only lose some of it. We tell you, though, that necessarily as well it's going to be poorly regulated. They say that, well, this is short-termist, but the very feature of a decentralized financial system is it has to be poorly regulated, right? For instance, you literally cannot implement laws against insider trading where the creator of a blockchain does things like advertise or hyperinflate their value, because then you would enter into that currency and begin the process of centralization. You restrict the ability of, for instance, someone to issue a currency that is their own. That is the feature of decentralization. It looks like things like the government intervening in the extent to which there is laws about you tracking the identity of the people using a currency, which is a feature of the decentralized financial system, which you literally cannot regulate insofar as you defend that is a decentralized financial system. And importantly, if they defend regulation, they're defending the centralization of the system, of government intervention into the system, which must necessarily remove all their benefits. Why do we tell you this is going to be so bad, though? Because insofar as it is poorly regulated, and insofar as people make poor financial decisions, we just increase the amount of risk that they can take on. That's probably quite bad, because you should not believe that people who are financially illiterate should be able to take on the kind of risk that can be associated with cryptocurrency and the extent to which it is volatile. But also, we would not expose them to the amount of people who have pernicious incentives using these decentralized financial systems. Every actor who's willing to create a coin or create their own decentralized financial systems to inflate the value and then simply pull out, because there are no laws about you having a vested interest in its currency, because that is the feature of decentralization, has to exist on their side. We say that you should not allow this to exist because it exposes people to these risks. We prefer that you could just do things like access traditional equity markets. You could do things like access traditional savings accounts, which are fine, which works fine, which were being rolled out in the developing economy. There's literally no imperative and no reason to risk people being exposed to these things. Finally, on the exigencies of crime and of corruption. They say that you prevent corruption because transactions are permanent, but this requires a provision of name, right? You have to have an identity associated with the hash. So as long as the hash in the blockchain is still anonymous, you can just do things like anonymously fund corruption. That was the mechanism we gave to at first. They got no response. But moreover, when they said that you now have, for instance, public coffers, like state coffers publicly available, they never gave a reason that developing economies would do this. If it's true that you're corrupt and it's true that you want to, for instance, be able to fund that corruption, you would just like never put your public coffers, your coffers public to actually allow this to do, which is exactly why their best cases never got used. But conversely, our best cases did. Because for instance, it was very easy for criminals to adopt cryptocurrency as a way to fund their ventures, but also as a way to money launder, which meant you didn't have to take risks of interfacing with the traditional financial system. We had things like identity checks to set up bank accounts, which made you simply far more likely to get caught, which was a benefit. But finally, on the environment, they say that, well, this is like all smoke and mirrors by the news media, and it's in normal finance. But even if the energy used to maintain the internet architecture is the same, things like blockchain mining still produces more emissions under their side. Panel, there is no benefit. I'm so proud to oppose.
All right, thank you very much. Second negative speaker. Can we have the third affirmative speaker to sum up the case for the affirmative team? Here.
The problem with propping up pegging your currency as a developing country with a precarious economic system was that it hadn't worked in the empirical reality of our world. You were still vulnerable to the instability, to all of that volatility that existed by virtue of you being perceived as a bad financial manager, by virtue of pegging, necessitating that you actually make decisions in certain circumstances to actually make your currency pegged to that other currency, by virtue of the fact you had the capacity to print more currency in instances of financial and economic instability. All of those factors were reasons for as to why the perception of governments in these countries as being bad financial managers, particularly of the physical and material financial systems, meant that you were less likely to get the type of investment, the type of economic participation, the type of benefits that we were talking about in this debate. Moving to a world in the blockchain, and we don't have to defend it in its nascency, in its most like embryonic iteration that we currently see in the world, but a future in which you have a more developed and robust standard of this is a future in which you are able to insulate against those harms. It is a unique benefit that we pushed and won on. Three things in this speech. Firstly, on the characterization of whether or not they were stable and not stable. Secondly, on the economic benefits, and lastly, on regulation and crime. On that first point about characterization, what do they tell you? They tell you they're fundamentally unstable and volatile because they're not pegged or they're not predicated on traditional assets or equities. A couple of responses here. The first of which is to say the precarity and riskiness that we perceive to exist with a lot of these is by virtue of the fact that they do not exist at scale. That is to say that they are by and large, their price is determined by a small group of financial actors that are presently deciding to do this. But the world which we detail for you is one in which you have a scale of adoption where you have a diversified set of interests which are driving the prices of those things. Obviously, diversification of interest means you likely get more stability in that sense. The second thing to say is just to be incredibly comparative. We tell you all of the things you need to insulate yourself against. The capacity of governments to print more money in circumstances where they are unstable or feel like they need to do that, leading to hyperinflation. The capacity of governments to do things like hide their coffers uniquely when they are not on a ledger. All of those things have unique risks that we think make people less inclined to invest in these particular countries. What else do we tell you though about risk? They tell us that you have worse decision making because it's volatile and you have less undergirding assets. Another response here I would just add was that it's deeply unclear as to why having a equity that this currency is predicated on, or having equity these financial dealings are predicated on, makes them less risky. Because we would actually tell you that at the point at which you are predicating upon something additional, you just increase the risk of that thing being compromised in the market, right? So for example, if it's a complementary good of something else, or asset of something else, when something other financial industrial system collapses, the underlying equity or asset that you were predicated on collapses similarly. So we just don't think it was true in this debate to say that not having something that was tangible meant that it wasn't good, because you insulated yourself from the harms of those tangible assets. The next thing to say though was about what actually happens in the economic benefits in this debate. And before I go into that, I just want to note and really reiterate that we don't have to defend the current iteration in its entirety. We do not have to assume that that is the invariable way that these policies will roll out, because the advent meant that it was coming into existence. It meant that it had the capacity to grow into the future. What we needed to do was look at the long-termist incentives and weigh the impacts of whether or not the short-term precarity was more important or less important than the long-term benefits we told you in this debate. Why did we get those long-term benefits? Why do we win? The first point, we tell you that you have the capacity to do things that are unique. This is just all of the material that we get from Liv about why you are able to not be exploited and held under the coercion of big financial powers. If you are Sierra Leone, if you are countries which were forced to take all of their coffers to have that kind of currency manipulation. The second thing we say there, and this is directly responsive to their point about you being able to trade and you being able to have really secure assets, is that at the point at which you are dealing in currency or traditional currency, we just tell you that other countries who you were trading against, your trading adversaries, were able to better manipulate your currency by buying up huge amounts of your reserves, by raising the prices of your exports. That was a unique thing that we insulated against. The third thing to say was that we insulated against all of the harms of perceived economic instability, all of the harms of government corruption, of all of the material that we brought you at Liv. We don't think it was sufficient enough for them to say that oh, you couldn't regulate, otherwise you made it centralized. It was simply true that you had ledgers. Those were things that you could check in a way that was categorically different to all of the other things that existed in this debate. Next, on regulation. Why do we think we get better regulation in this debate? Firstly, and let's note exactly what we're talking about, right? And this is directly responsive to the claim that we cannot regulate in any instances. They tell us that you have a lot of predatory practices that are inbuilt into these systems. We tell you that those predatory practices, not being able to see insider trading, having exploitation, weren't inbuilt, even if they existed, we contended that they existed all down the bench, but they were just by virtue of this being new. A couple of things here. First of all, we just tell you that governments have a stronger comparative incentive and ability to actually regulate these types of types of financial systems comparative to other ones, right? That was the fact that banks and institutions, particularly in the third world, existed as continuities of colonial oppression insofar as they were able to inbuild themselves into the structures of those governments, insofar as they likely existed for longer in a way that meant that it was harder to regulate them on the comparative than it was to regulate newer industries that didn't have that entrenched history within those countries. That means you have very greater political capital and capacity to actually do that. The next thing to say, though, is that we just think that for all of the reasons that they give you, right, and we flip the analysis of them being new, we are able to flip that analysis and tell you why the newness of this makes governments have an additional incentive to regulate it in a manner that makes it presented as stable and not volatile, in a manner that makes it seem a viable financial investment for countries to want to do business in that particular place. We think that we win on regulation, even insofar as the last thing that they tell us was technological expertise is harmful in this debate because you don't have the capacity to actually regulate in a way that's effective. Obviously, that is something that changes over time because you increase in your technological awareness of these technologies. We think that all of the things that they tell you at best were limited to the short-term iteration of these types of financial systems. At worst, they were long-term, but that was uncomparative to the way in which current financial systems operated. But lastly, and with the crime and corruption, right? They tell you that currently you have the ability to do things like crime, you have the ability to do money laundering. I just think they needed to be comparative to what financial institutions presently do. Because yes, it was true they have the capacity to check the identities of people who they did business with. We needed to understand whether or not their profiteering incentives led them to actually do that in instances where it was financially viable for them not to. Look at the fact that ANZ, a reputable and big four company in Australia, had allegations of money laundering, had instances where it wasn't actually adhering to regulation. Oftentimes, the reason for why we have crime in the world isn't because we can't see it, it's because prevailing economic incentives mean that banking institutions just have monetary reasons to actually do it anyway. But secondly, we just want to ask about the magnitude of impact here, particularly since they want to locate all of those harms in the third world where you already have a substantial amount of corruption. We tell you that you're able to have ledgers, even if it is the case that it is to some extent decentralized. We don't see that has a huge impact on that. The last thing, just on the public coffers, that is just empirically true in this debate, even to the extent that you're able to have a different identity on the ledger. That is comparative and analogous to things you could already do, like having subsidiary companies, having shell companies. They needed to actually prove on the comparative why this was uniquely harmful. We tell you that you cannot ever insulate the financial system from all of that corruption that already existed. But lastly, on economic benefits and the harms of not being able to regulate, they lastly tell you that citizens within that country have the ability to do savings, and that was more technologically tenable because you didn't have to roll out the internet. A couple of responses here. The first is to say that obviously being able to do good savings and traditional banks was contingent on being able to make good decisions on that. That was to some degree symmetric, probably more complicated by the existence of a variety of different equities you didn't know how to compare under their side. But secondly, it's important to say that even if in the present system not everyone does this, that doesn't matter because the setup that we gave you wasn't that it was universal adoption in the first instance. We told you that you likely had some incentives to keep cash on hand, but for people for which technology was inaccessible, they likely did that. But secondly, this creates a huge incentive for governments to probably roll out internet infrastructure and that technology which should necessitate the use of these bitcoins, right? Or not bitcoins, but these financial systems, the decentralized ones. We tell you for that reason, it was greatly important that you had the capacity to insulate yourself from the harms of colonial oppression. You had the ability to make yourself be perceived as stable and not have all of the precarity of the way in which you manage your financial system. We're so proud to affirm.
All right, thank you very much. Can we have the third negative speaker to end the constructive part of the debate before the reply segment?
I'm going to do two things in this speech. The first thing I'm going to do is engage with the opposition's best case, more notably the only case that they have ever decided to engage on, developing nations. Then what I'm going to do is I'm going to whip out material about the harms of cryptocurrency, because they just have simply not acknowledged the deep harms of current cryptocurrency markets that we've explained to you from first. Their lack of ability to acknowledge and engage in this material is damning because they know that they can't win it and they know that this material exists for debate. So let's start by being nice and charitable and taking them at their best. The first thing to say about developing nations is all of the reasons why they identify that it's hard for developing nations to create currencies now are things like changes in governments, unbalanced economy, conflict. These are all confidence issues. Confidence issues in the economy that cause you to lose investment investment, have people hold on to the money, etc. These are still issues with decentralized currency. Why these nations have the confidence to make a new currency with nothing but air to back it up is something that is unproven in the debate. But we also bring you further harms that even if they can just create the currency, we explain to it seconds that they don't have the infrastructure to back this currency up, right? They don't have crypto readers to back this currency up and to create that currency. So it's better just to like maybe back your current currency with USD or something like that. That is more effective. So let's talk about government regulation, because we explained to you a number of reasons why governments can't regulate. The first thing is, why do these nations have the know-how to regulate? Crypto isn't just hard to regulate because it is new. It is because it is confusing, right? A new decentralized currency, the newness isn't the problem. What we actually give you from Alex is the fact that it creates a significant amount of know-how to do this. For example, do you regulate this currency as if it's an equity, a currency, or a commodity because it behaves at an intersection of all of those things? Also, the second thing that we explain you from sound to no response is a heavy level of regulation is just centralizing your currency and underwriting it. Obviously, that is not a decentralized financial system. That is not the counterfactual in this debate. But thirdly, one of the big harms we explained to you is this thing about insider trading, which the opposition doesn't seem to understand. Essentially, like not regulating insider trading with these type of currencies is like you just being allowed to lie about the value of these currencies in ways that are quite harmful, right? But we also explained to you why even if you buy that these nations, I guess, can regulate these currencies, they do not have the incentive to, right? Why would these nations that have bad governments, are incredibly corrupt, all their mechanisms at first have incentives to regulate well? Why would they do things like blockchain identification? Why do they have the legal systems to back up any regulation that does exist? Obviously, that is incredibly harmful. We explained that the reason why confidence works better with traditional currency is it's because about people accepting this currency, right? And because people see all of these issues, a lack of a financial system that backs this up, lack of legal systems, lack of regulation, people have so much less confidence in cryptocurrency. And that is why cryptocurrency or decentralized financial currency is significantly more volatile. People are much more willing to take your just stock standard currency that is backed by the US dollar or something like that, rather than your decentralized currency. And that is why that trade-off is important. So let's look at their claim about group investment. Obviously, you can just do things like make a group backup account, make a group actually backed currency by the US dollar. Countries are also reticent to use shared currency for a number of reasons that are beyond crypto. Obviously, that is not the harm. So let's talk about Western exploitation, right? Because I want to say a couple of things about this. The first thing is that like, one, I think what is actually incredibly likely if you like unionize and create your new decentralized financial system is that the West just locks you out of financial systems because, as I've already explained, they don't buy that your currency is viable or logical or makes sense or is backed up appropriately. But also, I think the second thing we say is they can still be exploited by developed nations, because a lot of the ways that they've allayed the harms that I've just talked about is they'll just like, oh, we'll underwrite it with something. Developed nations control those things that you underwrite with. This exploitation is symmetric. At best, there is no change. At worst, they just get exploited more because their currency now totally relies on another nation because it has no other form of backing or acceptance or adoption. We also thought that there was just this overall adoption problem, difficult integration. People, they may create these systems, but that doesn't necessarily mean people will buy in or use them. The way that they try to allay all of these harms is they say, oh, scale. After a while, everyone will just adopt it. It'll all work out and it'll all be fine in the long run. But also, one of the reasons why these financial why confidence works is because there is very little confidence. That means that because of that, people just never adopt these currencies in the first place. They don't explain to us why any nations will be willing to take the L on moving first, on perhaps having less confidence, allowing other nations to move into the space. Obviously, this means that scale doesn't occur in this debate. The TLDR on all the things I've said about developing nations is that they never had the capacity to regulate, they never had the desire to regulate, even into the future. And it was unclear why any of this quote unquote, these changes actually improved their economies in ways that were important. So let's talk about our crypto content, because I think we prove a bunch of harms that are just simply not responded to. I think the first thing to say is that individuals engage quite poorly in financial systems. We say this to you at Alex, we say this to you at Sam, at no response. People don't have a lot of know-how. And we think that if people make bad decisions, crypto allows people to make more of these decisions and make these decisions more risky. Because the kind of contention that the opposition has with this is that, I guess backed currency is volatile. But one, this is symmetric because if you want cryptocurrency to work, it is integrated. But secondly, the most important thing about currency is backed currency means someone compensates you if something screws you over. Like if you have a financial crisis and your currency is hyperinflated, your government will now go and adjust it. Your government backs that currency in ways that are meaningful and makes it significantly harder for people to lose money. We explained to you a number of things. We explained to you that there are deep incentives to distort the value of cryptocurrency. Crypto influencers who tell literal lies about the value of their money, get people to buy up massive amounts of certain crypto, get their money out while it's significantly inflated, and then everyone else just gets screwed over in this process. Things that are not allowed in status quo, things like stocks, because they're regulated, but we explained to you down the bench why crypto is incredibly hard to regulate. Obviously, we explained to you that crypto is subject to a number of problems, things like bank runs, things like these insider trading influences, and the harms that occur when people lose out in cryptocurrency markets are just so much worse because there is no backing, there is no compensation, there are no avenues for legal recourse. This looks like people literally losing their life savings, people losing their houses, people losing their livelihoods. Obviously, this is incredibly harmful. This incomprehensibly actually happened in the world. All of the possible benefits about the developing world are speculative at best and deeply unproven. What we explained to you is something that has actually happened, that will continue to happen, and that actually harms people because they literally lose all the money they have and have no avenues for recourse. That is the biggest harm in this debate. That is the harm that was never engaged with by the opposition. We also proved to you just a number of other externalities. We explained to you that it just facilitates crimes that are really bad. They're just like, we would just make people use blockchain that way you have to use identifiers. But obviously criminals will just use anon blockchain to do things like money launder, do things like sell drugs, do things like fuel conflict and sex trafficking. All of those things are also really bad, also a great scale of harm, also unengaged with. At the end of this debate, you should believe that developing nations do not have the capacity or incentive to regulate. You should look at the harms that have occurred to people using cryptocurrency. You should look at the externalities, and you should weigh these last two significantly higher because we know it's happened, we know it's harmed people, and that's why we.
All right, thank you very much. Could you guys give me a sec? I need to use the toilet real quick. All right, let's go.
Double checking I can be heard. Starting my speech in 3, 2, 1. Panel, this affirmative team quite simply fails to identify sufficient unique factors of cryptocurrency to get them anywhere in the debate because they throw around words like underwriting and like being able to get investment. The problem is they never explain why there are insufficient avenues in the status quo to get this, and that's why they must lose. Firstly, on the marginal comparison in this debate, the first benefit of cryptocurrency they identify is that you can do things like savings, you can access development, particularly in the developing economies. We made the claim that as soon as you were able to access crypto, you're also able to access things like mobile banking, which fill the same role. We explained that you're also able to do things like underwrite any debt you want to take out in US dollars, which for reasons that we explained would be more stable and would be more likely to attract you the development. The next claim they made, and for that reason, there's simply no unique benefits to being able to access savings or access investment that comes with decentralized financial currencies. Secondly, they said it was trackable. We made the very simple observation that using blockchain to underwrite and track transactions in the existing centralized financial system was something that we could quite easily defend and something which would probably be consequential of the expansion of blockchain, and thus, again, was symmetric. Thirdly, though, they say that, well, the existing financial systems are more volatile because you're reliant on the prices of, for instance, other goods. The problem was this is symmetric. As soon as you used cryptocurrency to buy something, for the exact same analysis, it also came reliant on the price of that thing. Conversely, though, we said, and they conceded, that you were never going to buy bread or water or basic necessities with cryptocurrency. They never tried to claim that. They said they wouldn't. Importantly, that meant that it would always be more volatile than traditional financial systems because there wasn't the surety that if you held cryptocurrency, you would be able to make ends meet. You had to rely on the confidence of platforms like Tether and of Luna, which crashed regularly and which actually enabled you to use your cryptocurrency to suffice your daily living. Finally, though, comparing the ability to regulate these financial systems. The simple way to explain this is that the US government benefits from the US dollar rising. There's an intrinsic factor of a financial system. For the same reason, under their side, owners of these currencies always benefit from their currency inflating. They now just give far more evil actors the ability to benefit from the inflation of that currency and you cannot regulate it because it's an intrinsic factor of the fundamental system. That was the analysis that I brought to you a second. With that in mind, actually understanding the margins, we have firstly symmetricized all their benefits about the developing world. You can just do things like underwriting the US dollar. You can do things like access microfinance savings using banks that are rolling out in places like rural India, and that was absolutely fine. What we brought you, though, is that this is just a great avenue for people to lose their money. So we said that people were always going to be silly with their money and were always going to be vulnerable to pernicious financial actors upon them, and that this simply provided a great avenue for you to be exploited. You gave the owners of these new decentralized financial systems a great incentive, but also the capacity to benefit of doing things like artificially inflating that currency in order to make returns, but notably returns that came at the deficit of people. But even if you did not buy that claim, you should simply buy that if these financial systems are more risky, that is a risk that we should not allow financially illiterate people, particularly given the fact that by their own analysis, people in the developing world are more likely to be financially illiterate, access to the ability to lose their money, access to the ability to lose their life savings and lose the ability to functions and put food on the table. You should never defend that being a thing that existed in the world. Finally, on the exigencies, and here's where we extend the margin. Firstly, we say that you could just enable things like crime. Their response is that there's always incentives to do crime, which was our analysis, because they gave them an avenue to commit the crime, because ANZ had to risk losing their status and losing their ability to operate. But we said that anyone could make a decentralized financial system, which was exactly why you enabled more crime to occur if the incentive was symmetric. But secondly, we said it harms the environment because the act of mining and the act of finding all the blockchain hashes to underwrite these financial systems was going to do things like produce carbon emissions, even if the platforming of banking online was symmetric. Panel, there was simply no unique benefit that came with the adoption of decentralized financial systems. We could just do everything in the status quo, and I'm so proud to oppose.
All right. Thank you very much. Can we have the affirmative reply speaker to end the debate as a whole? Here.
An observation about side negative is that when you run a very, very defensive case, you make yourselves prone to losing a debate for an inability to prove discrete harms or discrete benefits, something that affirmative didn't in doing. What were the discrete benefits we brought you that stood at the end of this debate? That we incentivized the criminal regulatory capture of crime, untouched. that we hamper the ability for dictators and polycrats to do things like hyperinflate, and why that was a unique harm that stood untouched. That you were going to reduce corruption because these ledgers were public. The push you get from negative here is, no, you can just hide and it'll be anonymous, without ever proving why these systems had to be anonymous and why you wouldn't be able to be identified based on your past transactions. Sierra points that out and expands upon that in her speech. Fourthly, on the principled good of allowing people choice with their financial system. But fifthly, and most importantly, on how you could get rid of your colonial yoke when you band together and you make it easier for countries to do this. Because negative couldn't say, in one hand, any bozo can make a coin, and on the other hand say, these countries were not going to be able to make coins. Because what they misunderstood about Ecuador is it wasn't our ideal world. That was our analysis about how DeFi came about, through underwriting that allowed you to do things like borrow confidence, that allowed you to do things like patch over the short-term gaps that they wanted to sling mud at. Analysis, which obviously extends to their things about computers. That was how you got them. Those were the types of things that could happen, even if it was only going to happen in Ecuador, even if it only could happen in Ecuador. I would ask you then, panel, to weigh up the benefits to the Ecuadorian people, which would then stand against crypto bros and their families in the United States losing money. We win the debate on the narrowest and best cases for them. But we also told you, that they were going to be less unstable. The pushback from second neg is to say, no, because you can lose access to the internet. The panel, intuitively, what can you lose access to more? The internet, or also the internet and a raft of physical infrastructure that need to be staffed, that need to be accessed, physical infrastructure that could be more easily influenced. That was analysis we gave you down the bench. At that point, some of our benefits stand at the bare minimum, but they try and push back. They try and do this a few ways. They say, sometimes it won't be an appropriate thing to do. Okay, I don't see how that does anything besides narrow the raft of countries that we're talking about. They say, secondly, oh, you can't regulate because it requires know-how, which is uncomparative, as I point out, but also because regulation is centralizing, which is, once again, unresponsive to what we tell you about how when you have decentralized systems, you incentivize governments to try and regulate or compatibilize the functions above that system still operate. Things like the where you got the funds from without realizing that it is in blockchain that everyone has access to this ledger. That is why you couldn't do things like exchange funds secretively, given that all of your funds were going to be attached to your wallet. It was unclear how you could ever evade identification. That was their biggest push against. But we also got over their push on confidence because that glid together. At that point, they didn't do enough to obviate our benefits. I will point to that weighing about Ecuador, that weighing about crypto bros in America. What were the very few discrete harms they give you? Pernicious actors, which collapsed to crime and corruption, I've already touched upon, and an appeal to volatility and Doge. But that was uncomparative with the preemptive material Liv gives you when she tells you that these are likely going to look like country-sized economies or intra-country trading, at which point the comparative that negative needed to be drawing was between the pump and dump of foreign exchange monies, something that they never did because they failed to compare all down the bench. Where are their harms? They can't get an environmental harm by saying the word emissions. They couldn't get harms by casting harms on an imaginary world that no one ever stood behind. For those reasons, the only team with any benefit is proud to propose.
All right, thank you very much, all speakers, for that debate. So please leave the room now and let the panel do the deliberation. Thanks. All right. Hi, everyone. Thank you for that very high quality debate. So I'm going to give the verdict, and I'm going to go into the three main issues that I saw in this round. The first is the verdict. So we thought unanimously that the debate went to the side of the affirmative. So congratulations to Melbourne 1, commiserations to USU 4. So a couple of things I would like to, not a couple of things, but like one main thing I would point out before going to the main issues of this round is that for the purposes of this debate, the panel probably bought that this debate wasn't just about cryptocurrencies. It involved the broader blockchain technology ecosystem. This meant that the arguments around smart contracts and things like that couldn't necessarily be divorced from the purposes of this debate. So it's also just a debate about the advent of the decentralized financial system, which also means that it includes this ecosystem with all its different components. And so that's why we're more likely to believe that it was not just about cryptocurrencies. There were three main clashes in this round. The first was whether or not DeFi systems likely benefited the least economically developed countries. So I'm just going to call them LEDCs. The second is how likely is a regulatory framework going to develop for regulating cryptos? Thirdly, how likely will cryptocurrencies harm the many different societies that they are likely to pop up in? So let's discuss the first issue on whether or not DeFi systems are likely to benefit, whether or not LEDCs are likely to benefit from DeFi systems. All right, so a couple of things that we would point out here is that I think there's a challenge from the negative side that underwriting currencies are not part of this debate, and they try to basically co-opt this by saying that if it is true that underwriting currencies could be a thing, then that's technically something that we could do too. But the reason why it's unpersuasive is because the affirmatives case was about supporting decentralization as governments supporting, it was about governments facilitating and supporting that decentralization process, which reasonably involves underwriting currencies and using the blockchain technology to basically facilitate that particular thing. So it's not just it's not decentralization, therefore, is not denotatively for the purposes of this debate supposed to be you completely have zero government regulation at all, which is a very I guess the burden that the negative team tried to push onto the affirmative team, which is a very totalizing binary black and white way of conceptualizing the debate. So I think that was not particularly charitable of a burden of being pushed towards the affirmative team on that front. The second thing I want to point out under this clash that was relevant, I guess, was this issue of the exclusivity around whether or not these benefits are even good or not to begin with, and whether or not those benefits were exclusive to the F's world or the next world. So the NEC team points out that the mobile banking apps right now from big banks can also do these things. But the issue with that response in an attempt to undercut the exclusivity of the benefits that the affirmative claims here is that I think it's uncomparative. The analysis run by the affirmative team on the issue of how banks and governments really, really run shit to the ground a lot of the times. They do things like printing more and more more and more notes, and that creates inflation and things like that. But also more importantly, they demonstrate that there are lots of different incentives, political incentives of governments to also end up creating problems in the traditional financial system. So given that was the characterization that came out in first affirmative speaker, saying that the mobile banking apps could potentially do this as well, I think is not a symmetric claim that plays to the favor of the negative team, given that it still relies on the very actors that the affirmative team challenges as being not always the best actor. So the case therefore becomes about the expansion of the range of options, such that governments could do things like have more regulatory capture and things like that. But we'll talk about that slightly later on. But the other thing I want to note here is that the very same financially illiterate people that the negative team tried to push were also people that were, and it's unclear how the next site was able to basically help those people too with those mobile banking apps. So it's a bit unclear where that particular response was going towards. The thing then that the EF pushes quite heavily under this clash is that states mismanage the traditional financial system, as I've pointed out. So back currency, you have doing things like currency manipulation to increase the competitiveness of the exports, speculative attacks on currencies, dependence on colonial powers, printing more money. All these things, I think, were ways that they tried to characterize problems with the traditional financial system. And the way that they basically responded in negative side is to say, and this is what NEC's main claim is, right? NEC's main claim is basically that if you're going to have all these problems, it's likely to be A, either symmetric on both sides, or that B, it's going to be something that ends up your alternative on F basically locks you out from the West. But I think the reason why that second response is unpersuasive is because I think the affirmative, that's firstly contingent on the West not locking you out because they've not had widespread adoption of these particular I guess cryptocurrencies or these blockchain technologies. But I think the affirmative team proves that there's likely to be a widespread adoption in a world in which people are more likely to basically believe that there's less risk because of the widespread adoption. So I think on that first level, I think that response didn't quite work. But the second thing is I don't think that there was a very clear response to why those states were better at managing those currencies such that they had to be the only actor that was able to basically do this. Because I think in the affirmatives world, they already preempted this by saying that, look, like clearly you don't governments will continue, sorry, not governments, but like banks will continue to exist. People can still go to banks and things like that. So it's unclear for me as to why that tipping point was necessarily proven by the negative team under this clash. The other thing I would point out about LEDCs is that the affirmative team points out quite a number of things about how like the LEDCs are able, or people living in LEDCs are able to sidestep a lot of the usual problems associated with governments at the LEDC level, just not really being able to agree on what to peg currencies to, or like because of instability in the region. I think the way that the affirmative team proves that this is like they're likely to get over this is to point out that a lot of the times, like the reason why these are like a lot of the times, like these sorts of decentralized financial systems aren't necessarily connected specifically all the time to various political actors that might or might not disagree. And so it's a bit easier for money to be moved around perhaps in the LEDCs for that reason. The other thing that I think just doesn't get quite a clear response is from the negative side. So I think affirmative pushes that smart contracts are part of this debate, and like the LEDCs often are able to have that sort of reliance on smart contracts, which is preferable. But I don't think that the negative team really directly responds to this. I think the negative case very largely hinged on cryptocurrencies as a clash. So on this issue of like whether or not DeFi systems are likely to benefit the LEDCs, I'm willing to buy that there are some risks associated with these DeFi systems, but it seems that at the end of this debate, there were more benefits that were likely to outweigh those risks that the negative team pushed towards the LEDC's context specifically. I'll talk more about what those risks look like in the other clash about the cryptocurrencies. But like the second clash then is how likely is a regulatory framework going to develop for regulating cryptocurrencies. And the negative team's push back towards the F's case is that a lot of times the reason why there's no regulation is not because it's new, but because it is confusing. The reason why that line of response was not persuasive was because it was a bit unclear as to why that was why that necessarily responded to the characterization of why there's a lack of regulation. Presumably it's because, like, I think the F team points out that the newness is what causes the confusion. So the time lag to respond and things like that, I think are things that eventually became less persuasive in the round. But secondly, I think the reason why the time lag to respond thing, I guess, got mitigated by the F team was because I think they were able to prove that a lot of the times these incentives, there are incentives for governments to do regulatory, more regulatory work with widespread adoption. So like budding models of like regulation, or rather regulation that facilitates the integration of those blockchain technologies or cryptocurrencies would be the example of Ecuador, not Venezuela, Ecuador. So it happens, I think, on their side. I think F proves that it is more likely that there is some degree of scrutiny that's more likely to be the norm for governments, especially. So it's not really particularly persuasive at the end of the debate as well for the NEC to say that there's no regulatory framework that's likely to develop. I think there's some framework that's probably going to actually develop. The response from NEC is that regulation is definitionally not decentralization, but I pointed out here earlier in my OA that the point is that I think the F's case is about forcing governments to adapt regulation towards the direction of promoting that decentralization while minimizing whatever harms that have accrued in the status quo because of blockchain technologies being sparsely regulated. So the third clash then on how likely will cryptocurrencies cause harm to societies. So a couple of things here. The first was on insider trading from the negative side. So the negative team pushes that insider trading is much harder to resolve. The affirmative team says that the ledger being publicly available makes it easier for us to basically track and scrutinize those transactions and to understand and pick up on insider trading. The negative side says that whoever created that cryptocurrency is able to basically manipulate that. The affirmative team points out that that sort of like thing also happens in the real world right now anyway. Like people who own those particular companies presumably also have stocks like that, they like, as in they can still give insider information and things like that. So it's unclear for me as to how that necessarily how it seems like the worst case scenario seems to be quite similar there on insider trading. But I think the affirmative is able to prove that it's likely in the best case scenario that they are able to use that decentralized ledger to create more scrutiny and transparency around that information. So the other thing that was raised by the negative team under this clash was this idea of the pump and dump schemes. So this is where I thought it was quite symmetric on both sides. So obviously on the next side, they say that there's influencers that are trying to basically create hype around a coin and then like screw people over for that purpose. And then like the F points out that you look like pump and dump, like people inflate currencies artificially all the time. This is something that governments are quite good at. So it seems like there are forces that symmetrically create the effect of those pump and dump schemes, or like uncertainty and uncertainty around those currencies. So like it seems like it's quite symmetric there. So I didn't think this was adequately weighed out in the round, such that it was, I guess, meaningful for the clash to be broken on this particular exchange. The next thing then, I guess, that's quite important is this idea of crime. So the affirmative team points out that a lot of times the way that they are able to overcome crime is often with the case of like coming up with new identifiers, and I think they highlight the Pakistani model, and they prove that it's probably like within the range of like plausibility and likelihood that you are more likely to see some degree of regulatory capture. And as a consequence, I was more willing to believe that that Pakistani model or whatever preliminary breakthroughs that were made in that model would be implemented in the long term. The response we get from the negative team is that this is a very speculative benefit at the end of the day, but it's unclear why that's true given the trend analysis that the affirmative team points out. The other thing is just like there's this claim that I guess people can just assume certain identities. So affirmative points out, negative team points out that people can just like sidestep bank verifications in the affirmative's world. The affirmative points out that sidestepping identity verification can happen in the form of having subsidiaries and things like that to basically illegally move money around. So it seems quite symmetric at the end of this debate on both sides, that the worst case scenario is people basically using the respective financial systems to commit crime. But what I was more likely to believe was that the affirmative team was able to mitigate some of that within their model when they discussed the ways in which they might be able to mechanistically create some level of accountability through the identifier model. So I think on the affirmative world, maybe they have some crime, but it isn't like they are able to basically like, it isn't like they are incapable of being able to figure out what's happening in the crime there and things like that. So the last thing then under this clash was this idea of the environment. And this is where like the negative team pushed quite significantly this idea of the environment and how there are lots of harms associated with emissions. This needed to be weighed out against the benefit specifically from the affirmative side that basically ran that it was easier for people to move money around without governments touching that money. So for example, in this case, like with building popular resistance towards oppressive regimes, it seems like that particular benefit was more central to the debate for the reason that the affirmative team puts out from the very start, which is this idea that LEDCs specifically are able to benefit from this, or like people living in oppressive regimes in the developing world would be able to access that sort of solidarity building and like community building through moving that money around through the decentralized financial systems that exist outside of their particular oppressive regime's case. It seems like that had more weightage as opposed to the environment argument, which wasn't weighed out specifically, I guess, to why that might have been the most important argument within the round, or the most important harm to consider within the round. So for that reason, I was more likely or more inclined to believe that while cryptocurrencies did have some harms in that they might be environmentally unfriendly, it was still, for the purposes of this debate, more important that we consider the ability of cryptocurrencies to basically unite people and basically push these, I guess, like LEDCs and like give these LEDCs a chance at being able to help build their own communities that go against and resist their oppressors and things like that. I was more likely to believe in that finding it in the exchange in the third clash that the affirmative was able to take that exchange. And for that reason, that they, I think, quite plausibly prove that they are able to mitigate a lot of the harms surrounding cryptocurrencies. And that's the reason why I thought that the debate overall went to the affirmative side.